Yeah, good, thank you.
Okay, great. Well, good morning, everyone, and welcome to the Liberty 2 Degrees pre-close presentation. In starting, I'd just like to thank you all for taking the time to join us this morning. And of course, a big thank you to the L2D management team for giving us the opportunity to host them. Just in terms of the agenda for this morning's call, Amelia and Jose will be taking us through the results presentation, which was also published on SENS this morning. Thereafter, we'll move to a Q&A session. Please post your questions to the chat function and we'll be sure to get through all of them. Just a reminder to also please stay on mute. And with that, I'd like to hand over to Amelia. Thank you all very much.
Thank you so much, Pranita, and good morning, everyone, and a warm welcome to you from a cold Johannesburg. Thank you all for joining our pre-close presentation. We're going into our interim close period on the 1st of June. It is also our AGM later today, so we are using this opportunity to do this operational update ahead of that as well. For L2D, value is inherently tied to our purpose of continuing to create experiential spaces to benefit future generations. This benefit goes beyond the in-the-moment experiences that we wish to create in our environments. We want to produce lasting impressions that tie to an enduring legacy of a positive impact that we want to do through the good that we do in our business. Our strategic value drivers that are supported by our building blocks remain key business enablers for us and the basis of all our experiential initiatives within our spaces. The easing of lockdown restrictions and the move towards a post-pandemic operating environment is encouraging for us as we see retailers and customers gain confidence. You just have to walk around our malls to see how busy they are and how people have returned to these environments. However, the onset of the fifth wave is now a reality and is of great concern to us because we know that with COVID cases on the rise again, caution is required as it can very quickly turn things around. As we navigate uncertainties of global proportions that impact our domestic economy as well as our business, it requires that we remain committed to the goals we have set for the future and our business and all our stakeholders. Our teams are very, very focused on driving operational performance. We keep that in mind every day because it is only through changing around the operational performance that we will eventually get back to pre-COVID levels. We have seen great improvement in our key operational indicators when we compare it now to 2019, which we will show you later in the presentation. The portfolio is making really great progress year to date on many of our strategic initiatives, which includes a focus on leasing to reduce the reversion impact. That is really something that we look and drive at every day and trying to make sure that we can turn that trend around. Cost savings in an environment where costs, especially municipal charges, have really gone out of control, and also some income protection initiatives. We are focused on the key actions in our business that drive growth and sustainability to ensure that we remain purposeful in how we deliver on our strategic initiatives in 2022. If we look at the portfolio foot count as part of our customer experience strategic driver, adapting to change is not a new concept for shopping malls, and even before the COVID-19 pandemic, we were faced with many challenges already, including the rise of online shopping, shrinking foot traffic, although we haven't really seen it in our malls specifically, but changing consumer shopping preferences. People start to shop differently, and I've said this many times, that we are passionate about understanding customer trends, understanding how people shop, so that we can respond to that and give the customers what they want. Despite the continued threat of the COVID variant, of the different COVID variants, it is encouraging to see the return of our customers, with over 23.5 million customers entering our shopping centres in the first 4 months of this year. The portfolio has seen a higher number of customers entering our malls compared to the prior 3 years, indicating the return of demand to brick and mortar retail, as well as confidence that physical retail and online retail will exist successfully in the future. I think it is such an important concept that we embrace in our business, that the one needs the other. The physical environment needs online, but online needs that physical environment where people can touch and feel and have a slightly different experience. The increasing foot count, however, does not take away from the fact that customers has become accustomed to the convenience of online shopping, but they continue to seek that experience when they do shop. It is therefore our responsibility to provide that environment that caters for both convenience and experience, and our teams have really done a great amount of work to continue to bring that to our mall. Mahatma Gandhi once said that a customer is the most important visitor on our premises. He is not dependent on us. We are dependent on him. And I think that's now more true than ever. Sandton City continues to evolve and operate as an iconic space, attracting almost 17 million customers over the year in 2021. And we've already seen close to 7 million customers visiting the mall in 2022 up to April. We continue to drive value for our customers by extracting pertinent information such as the number of customers, the customer flow and dwell time from the smart cameras that we have installed. This enables us to make informed decisions and create beneficial spaces for customers in our malls, and through that, helping our tenants. In 2019, Sandton City launched the Baby Care Lounge that you will remember if you've been here on a walkabout with us, that was designed to offer a safe, comfortable, and soothing environment for parents and caregivers to use at no extra charge. And at the beginning of this year, we embarked on another journey driven by our smart camera data to create a Moms and Pops baby node on the upper level outside of Woolworths, where convenience meets experience. And if you have seen that, you would have seen how people enjoy that space. The node targets young families with the launch of the Crazy Caterpillar play area that we have launched there. This offering is free for customers and provides an interactive experience to keep young children entertained while one parent can attend to the shopping. The upcoming opening of our Baby City and the other complements and the other tenants in the area complements this, and with the existing tenants that we have there, that has now become a whole new node. We're also busy upgrading the bathrooms in that area to create that. And this is just an example of how we now use the data that we get from our smart cameras and the other customer insights that we get to address the need of our customers. Sandton will also be hosting South Africa's biggest pop-up retail market, Kamers, in June, and that's another great experience that we can look forward to. Much has been spoken about hospitality and the impact of hospitality on during COVID, and it's really pleasing for us to see that the Sandton Sun achieved an average occupancy of just under 70% for the first 4 months of the year, and just over 71% for April. Weekends continue to attract higher demand with an average occupancy of 77% on Fridays and Saturdays. And the respective weekdays reflected an average occupancy of 69%. So you can see how improved demand from corporate bookings, indicating a positive movement in corporate travel, both domestic and international. The Garden Court has averaged 36% occupancy, and we see that increasing every month. The Sandton Towers, which is the old Intercontinental that is getting rebranded to the Sandton Towers, it will reopen on the 1st of July, and we look forward to introducing that back into our hotel mix. The Sandton Convention Centre has had a good start to the year with 47 events up to April, compared to 60 events for the full year in 2021, and most of the events are looking to book again in the upcoming months. This all bodes well for future months and into 2023. Whilst there's a strong recovery in hotel occupancy, further improvement is required to get it back to pre-COVID levels. If we can go back to the retail portfolio and our turnover experience, you would have seen that Stats SA recently released the annual sales up to March 22, and it is encouraging to see the recovery of our portfolio ahead of the market, despite increasing pressure on household discretionary spend. The portfolio turnovers continue to show very good growth, with Q1 achieving 13.6% ahead of Q1 in 2019, generating turnover of 4.5 billion in the first quarter of the year. The turnover for the first 3 months of 2022 is higher than the corresponding months over the past 3 years. And if we consider the annual turnover up to March 22, the portfolio is now 2.1% ahead of the 12 months leading up to the onset of lockdown. This recovery also translates into the trading density growth of 5.5% versus March 2019. With our current tenant mix and future tenants opening soon, we expect to see this trend continue throughout the year. We remain cautiously optimistic as we observe rising costs that reduce our customers' overall spending ability, and we will continue to introduce new brands to bring them to spend their share of the wallet in this environment. As we said before, these increased turnover experiences take time to convert into rental impact, and Jose will unpack that a little bit in terms of our reversionary trend at the moment. If we just spend a little bit of time on the centre specifically, the macroeconomic factors that influence the spending ability have varied across our portfolio, and we do continue to evolve and adapt our offerings to attract customers and ensure sustainability for the tenant in each specific mall. Sandton City continues to outperform the market. It's just extraordinary, having reached and exceeded pre-COVID levels every month since August last year, with Q1 now being 29.5% ahead of Q1 2019. This is about 2 billion rand in turnover for 3 months. The retail categories that well exceed pre-COVID levels driving the performance continue to include the luxury brands, the grocery and supermarket category, apparel, and technology. Normalizing the change in trading tenants, the average trading density for the first quarter is 23% ahead of the Q1 2019. A few categories are still marginally below 2019, with department stores, books, cards, and stationery supplies performing at the lower end. However, they're narrowing their gap in the past 2 years. I'm particularly encouraged by apparel coming back because it's such a key driver of mall performance. Although Sandton City is a standout performer in our portfolio, the remaining portfolio, excluding Sandton, has also exceeded the Q1 pre-COVID levels by 3.8%, and this remains ahead of what we've seen released for the market. Mittens Mall has also stood out as a very good performing regional centre with quarterly growth of 27% ahead of 2019. Categories driving this positive turnover include health, beauty, grooming and wellness, apparel, technology, department stores, and the grocery and supermarket category. The categories that track below 2019 levels there include accessories and books, cards, and stationery. The average trading density for the quarter at Midlands Mall is some 20% ahead of 2019. Eastgate is tracking now only 5.6% behind 2019, closing that gap of the closing the big gap that it had. And it has focused on evolving over the past 2 years in line with its customer base. Although the apparel and technology categories have seen significant quarterly turnover growth, department stores, food services, and specialty and homeware are still under pressure. Promenade is tracking 4% behind 2019, and although pre-COVID levels have not yet been reached, we continue to see good monthly improvement despite the economic factors affecting the surrounding community of Mitchells Plain. Botshabelo Mall is our only community centre within the portfolio and has shown consistent growth throughout the pandemic, achieving turnover growth of 41% for the quarter compared to 2019. We've also seen significant recovery in turnover growth at Nelson Mandela Square as customers return to dining at restaurants. The square is predominantly restaurant focused, driving the improvement in turnover growth for the first quarter to only 7% behind 2019. As tourism picks up, the restaurants as well as other retailers will once again take advantage of the influx of international retailers. Overall, the portfolio continues to improve, and based on April turnovers received, the portfolio turnover growth remains ahead of the same period in 2019, with turnover for all the shopping centres surpassing pre-COVID levels, bar Nelson Mandela Square, which is only just 1% behind 2019. Tenants and our tenant experience are one of our most important value drivers and something that we continue to focus on. It's key to our delivery. It is through our leasing initiatives that our retail portfolio has seen an increase in demand, allowing us to customize our tenant mix. Some of our new tenants include lifestyle brands like Sea Folly, Creolin, and One Body, Mind and Soul, as well as new coffee and pastry offerings, Casa de Nata in Sandton. Hi-Fi Corporation recently opened its store at Eastgate Shopping Centre, and I was so encouraged seeing what a beautiful store that was, spearheading the growth of the value offering with PEP and PEP Home opening there soon. Eastgate also has introduced Kazuka, creating a physical presence for a predominantly online car marketplace, further enhancing the diversification of our tenant mix. Through our effective tenant relationship management, we continue to seek opportunities for tenant expansion across our portfolio. It is promising to see a total of 47 new deals concluded in the portfolio up to April, and we continue to drive innovative leasing, ensuring a tenant mix experience that sits close to what our customers want. I'm going to hand over to Jose to talk to us about the rest of the portfolio, and I'll come back.
Thanks, Amelia, and morning, everyone. Welcome to the pre-close presentation. COVID-19 and the resulting trading restrictions undoubtedly had a negative impact on the occupancies across our portfolio. Our retail portfolio has seen significant recovery, though, and is starting to reach occupancy levels in line with, and in some cases, better than in 2019. The office portfolio has unfortunately not seen the same level of recovery, but in our view at least is starting to stabilize at the current occupancy levels. The numbers that follow exclude Melrose Arch, which is predominantly an office precinct in which we have a minority stake and we don't manage, and that data we'll dive into detail around Melrose Arch in our mid-year presentation. The retail portfolio continues to see high demand for space.
Sorry, Jose, you've gone on mute.
Renita, can you hear Jose?
He's still on mute, Amelia.
Can you hear me now, please?
Yes, that's great, Jose. Thank you.
Sorry, is that better?
Yes, yes, it is.
It also just put this back on.
Jose, can you hear us?
Can you hear me now?
Yes, we can hear you.
Okay, thanks. The retail portfolio see high demand for space, achieving an occupancy of 97.3% at April 22, ahead of our December 20 of 96.9%. Sorry, let's just close the speakers a bit. Can you hear me?
Yes, we can.
Okay, thanks. Including space that has been let but is not yet in trading occupation, the retail occupancy improves to 97.8% and remains ahead of the Q4 2021 MSCI retail benchmark of 94.4%. Our super regional centres, Sandton at 98.2% occupancy and Eastgate at 94.8%, have maintained a combined occupancy of 96.6%, ahead of the Q4 2021 MSCI super regional benchmark of 93.5%. This is a testament to the quality of these two assets in comparison to their peers in that category. Whilst the office portfolio was significantly affected by the pandemic and remains under pressure from oversupply, we are optimistic that the office sector is starting to stabilize, as we note more interest from tenants wanting to occupy office space and the return to working from offices for many tenants in our portfolio. The office portfolio achieved an occupancy of 88.1% at April this year, improving from 87.7% in December, excluding Marvel's Arch. This remains ahead of the MSCI Q4 21 office benchmark of 84%. As we navigate through the oversupply of office space, we remain confident in our premium grade office portfolio and focused on attracting new tenants through creative offerings. In terms of the full portfolio at the end of April 2022, portfolio occupancy was 92.7%, with future let space not yet in trading occupation, improving the occupancy to 93%. So in summary, our occupancies for retail at 97.3%, offices at 82.6%, and for the combined portfolio at 92.7%. About 14% of the GLA of the portfolio, of about 330 leases, are coming up for renewal in 2022. As you'll see from the slide, of that 14%, about just under 4% has been concluded so far this year. At April 2022, the portfolio reversions concluded are tracking at minus 18.5% at a portfolio level, with retail being at minus 17.2% and offices at minus 25.1% respectively. I think that was one of the questions that have come up in the chat. Although we are seeing an improvement in the reversion downside trend, this does continue to have a negative impact on earnings and speaks to the reality of the retail landscape coming into 2022. Further context must be given to the fact that the retail and office reversions currently concluded so far during the year accounts for about 2% of GLA, whereas in-force leases still account for more than 50% of the portfolio total GLA, and those still have weighted average escalations of 6.7%, as we discussed in the results. When looking at the bucket of tenants that have renewed to date, the Q1 performance are seeing encouraging.
Sorry, just a reminder for everyone to stay muted. Thank you. Sorry, Jose.
And to emphasize, although we are seeing significant improvement in turnover levels across predominantly the retail portfolio, it remains to be understood that doesn't mean it's an even spread of improvement across all tenancies and necessarily doesn't impact the guys coming up for renewal this year in the same way as it does the balance of tenancies across the portfolio. There, by its nature, is also a time lag between turnover improving and when we can improve the rentals underlying the portfolio that is coming up for renewal. We remain optimistic that the improving turnover trends will support our negotiations with tenants through the remainder of this year, and that we will start seeing an improvement in reversions rate. Our balance sheet remains conservative with a healthy loan to value at just above 24% at the end of April. Our hedge ratio is 75.8%. The duration of our debt expiries and hedge profile at just over 2 years is at the short end, but this will improve after we have refinanced about 850 million of our term debt that is expiring in October of this year. We are moving forward with the sale of the Standard Bank Centre in the Joburg CBD. Both parties have filed the application for approval with the Competition Commission, and we expect transfer of that property to happen in the third quarter of this year. Our risk management processes and conservative deployment of our resources ensures that we remain well capitalized as we continue to navigate uncertainty and safeguard the interests of our investors and create sustainable value for our stakeholders. We regularly review and monitor our top and emerging risks with a high focus on mitigating risks that could have a significant impact on our business. We continue to emphasize our ESG initiatives. We are committed to driving our sustainability targets of being net zero waste ready by 2022, to attain net zero waste certification in 2023, and achieving net zero water by 2025 and net zero energy by 2030. We have successfully completed and commissioned the Promenade solar PV installation in May this year, 2 months ahead of expected completion. The Midlands Mall 4 megawatt PV solar project will commence in the fourth quarter of this year, which will further reduce the consumption and reliability on the Eskom supply by about 30% of what we utilize at that mall. The completion of that project is anticipated to be in the second quarter of next year. Our net zero targets for waste are on track for 2022, with the portfolio waste average up at 76% year to date from a base of 36% in August of 2021, based on different utilizations. The portfolio continues to improve its diversification, its diversion from landfill of solid waste. Our efforts in last mile waste management solutions such as dry composting and contaminated plastic waste management will bring the diversion ratio closer to 100% going forward over the next year or two. Several projects have been initiated for the water net zero targets for 2025 and our energy net zero targets for 2030, which focus currently on the conversion of our HVAC systems and from water-cooled systems to air-cooled, utilizing rainwater harvesting, and the installation of solar PV panels across the majority of our portfolio assets. Thank you, and I'll hand back to Amelia to conclude.
Okay, thanks. Thank you, Jose. Just onto our people. Earlier on this year, we welcomed Nick Kritikos as our new chairman of the board. Nick carries a vast amount of property experience in South Africa and internationally, and it is great to have him on board. We successfully maintained our level 2 BBBEE rating for 2021, and that is a testament to our commitment to broad-based transformation. We are dedicated to positively transforming the property sector. We continue to contribute to programs that make a difference and support small Black-owned businesses through entrepreneurship and business skills development. When the change in the codes is expected to come into effect in 2022, there will be some changes that we will also be mindful about, but our transformation priorities include being adaptable in our strategy to incorporate the new codes once adopted and ensure that our overall spend on this, optimizing this for our business and for doing the right things. To conclude, the country was once again into a state of disaster due to the recent flooding in KZN. Our thoughts are going out to everyone that's been severely impacted by that. But that has also further strained the South African economy. Fortunately, our assets in KZN were not impacted by the extreme weather conditions in the province, but it just is focusing our attention so much on our ESG and sustainability initiatives. Notwithstanding the improved operational metrics, we remain realistic on the uncertainties which prevail. And I know that there is a request for us to provide guidance, and we will provide some forward-looking guidance when we bring our results out during our half-year presentation for the full year. And once we have done our half-year numbers, we're in a position to do that. The real task for us will be to ensure that we build on this momentum. We focus our business every day on the execution of our strategic priorities, on letting the space, on keeping the malls full, on bringing customers here, because it is only through that we can ensure that we continue to make gains that translate into improved financial results and a stronger business in 2022. Thank you, Pranita. We'll now take some questions. There are some questions in the chat. You just tell me how you want to handle that.
Perfect. Thank you, Amelia and Jose. I think what will work best is if we maybe go through the questions for the benefit of everyone. I'll read them out and you can address them accordingly. Maybe before I get to the questions on the line, just a reminder to everyone that if you do have a question, please do post it to the chat function. Maybe just from our side, and Amelia, I know you've touched on it in terms of guidance, but I think maybe just to take one step further or try to from my side. We've obviously seen a lot more companies providing guidance now that COVID restrictions have relaxed and things have begun to somewhat normalize. Given that your operating metrics have improved notably, I guess the market will likely anticipate this translation through to interim results. Can you maybe on a high level provide us with any expectations you have in terms of earnings for your upcoming results?
In this presentation, we provide the experiences of our reversions. And as I said, we will look at when we bring out our half-year results to give some more clarity on the financial performance for the full year.
Thank you, Amelia. Okay, maybe I'll kick off with one or two of the questions on the line so far. Brendan, I think Jose has addressed your first question, so I'll move on to Nazim's question. He asks, can you provide growth numbers for apparel, two largest assets only, SC and EG?
Those are some details that we'll ask Terria to get back on those numbers. I don't have that. We don't have that here with us.
No problem. The next question comes from Naeem. Can you disclose how much the hotel revenue per available room is year to date compared to 2019?
Not at the moment, Pranita. I think the issue for us is one of the hotels are still closed. The other one has got occupancies below half of where it would have been so far in the comparative year. We'll give a bit more detail on the hotel ratio specifically at mid-year, and after we've seen how the Sandton Towers has opened and is trading and what the environment is like for them. I think in terms of our guidance, there was a lot of discussion at year-end around the breakdown of our income streams. And although we talk a lot about the retail, which is predominant in this portfolio, it remains a challenge what is happening in hospitality with the convention center and the other assets in the portfolio that I would just guide towards, please. Yeah.
Okay, thank you, Jose. The next question is from Fayyad. Are hotels still operating under care and maintenance agreements? If so, when do you expect this to revert to old leases?
Yeah, I responded to that question in the chat. They are still under that arrangement. We'll open the Sandton Towers now and see how that trades through the remainder of the year. We'll reevaluate probably after seeing how that hotel performs for 3 months. When a third of the assets are not open, it's a bit difficult to negotiate with the operator around the leases. It is still the same operator that we'll continue with under the rebrand.
A question from Red One. Given strong rebound in footfall and trading density at some of the centers, are you concerned that department stores still lag? Do you think there is a place or is more drastic change still needed?
I think there is definitely a place for department stores, and we've seen, although they are still lagging, there are still some specific ones that have had some challenges. But we continue to engage with the department store tenants. They have a place in super regional malls. They do bring people to these environments. And, we know that Edcon, the turnaround numbers for Edcon are in the base, so that could be impacting that. But I'm comfortable that these tenants are trading where they should be trading, and we've been having some very encouraging discussions with some of the large retailers around their plans, what they are doing, and comfortable with where they are. And we'll continue to watch this and make sure that we don't have exposure to them. Too much exposure to them, taking space back where we can, cutting out space in the front of their shops to reduce that impact in the case of something happening to them.
Okay. Paulo's question with regards to the Sandton Towers rebrand and whether this is the same operator. Jose has answered that it is. So I'll move on to Jared's question. Is the updated LTV to April based on December valuations? Jose has responded to that as well, that it is.
Pranita, can I just jump in there while you're talking about the valuations, right? So you guys at the FY21 result, you guys had made some mention about the Eastgate valuations being impaired due to the economic weakness in the immediate catchment area. I wanted to figure out if you guys have done sort of similar analysis to the rest of the portfolio right now.
Yeah, we look at it for the balance of the portfolio, but I think the difference with Eastgate and why we commissioned that study is that Eastgate has had some difficulty for some while over the last number of years post the redevelopment of that mall. And we've seen competition come up, and we've seen a shift in spending patterns in that catchment area that we needed to identify where it was going and what the need is for those tenants and for those consumers. Which speaks to, I guess, the drive to offer more value offerings as part of that mall, which you will see being implemented with the tenancies that is coming in there now. We haven't seen a deterioration similar in any of our other assets over the last number of years. And in fact, are starting to see, as you will see from the numbers, improvement in spend at all of the assets. Sandton City, for example, is now better than when it was in its history. And the top end LSM spend at Sandton City is continuing unabound. We thought that with travel restrictions being lifted, the spend in the ultra luxury would maybe migrate, but it hasn't. So far, it's still continuing quite strongly.
Pranita, okay. Can I go to the question on apparel turnover growth?
Yes, absolutely, Amelia.
So for Eastgate, for Q1 over 2019, the growth was 7.1%. For apparel, that is, and at Sandton 17.8% versus Q1.
Great, thank you for that. Okay, just moving on to the next question then from Francois. Can we get a sense of the change in like-for-like net rental income compared with, I'm assuming the 4 months, beginning 4 months of 2019?
Thanks, Pranita. That level of detail is typically for the year-end and mid-year presentations. We don't present that at pre-close calls.
Okay, thank you, Jose. Just a reminder again, if you do have any more questions, please post them to the chat function. Maybe just in the interim from my side, just given that you have, a lot of balance sheet capacity still, I was just wondering if there are any feasible, is there any feasible optionality to utilize that balance sheet capacity at the moment, and are there any initiatives that you're currently exploring in that regard?
We are very, very focused in driving our operational business at the moment, investing in our assets, what they need to be able to turn their performance around. And to convert the trading density growth into rental. That is our key focus. And that is what we are going to stick with until we can get that right. The balance sheet is there to assist us where we need it, and we will use it when required. But focus in our driving operational delivery is our key priority, and we keep everyone to that at the moment.
Maybe just coming back to the operating environment, are there any tenants or category of tenants that you're currently still concerned about? And are there any that you're still potentially providing rental relief to? Obviously cinemas and sort of entertainment components have been one of those previous sectors of concern. Have you seen any pickup, since the easing of restrictions, particularly on the cinema and entertainment side of things?
We've seen good recovery in the cinemas. There's the business rescue for the cinemas have also been primarily concluded. Jonathan's concluded the deal with them for that going forward, and there are some very few of the restaurant tenants and quick service offerings that we are still needing to support, but those are mainly all done, and I think everyone is back to normal environment.
Okay, thank you, Amelia. Coming back to some of the questions on the line then, we have a question from Vincent. He says, I struggle to reconcile the reversions with the trading density comments. What trading density growth is needed, and is this specific to certain tenant types?
Yes, it is. The reality is, if a tenant's turnover density is up and their turnover growth is positive, and we're busy at that point in time negotiating their lease, there's not going to be a negative reversion. Okay. What we are seeing in the mall at Sandton City, as an example, is luxury and ultra luxury growing substantially, but those aren't the leases that are renewing this year. The guys that are renewing this year are still having trading difficulties, and in various categories of them, we are starting to see a return to better trading for them, and then have a stronger negotiating position with some of those tenants. So at a portfolio level, you are seeing turnover growth returning and normalizing to pre-COVID levels. Okay, but that's at a total portfolio. Within the portfolio, only 14% of the total space is coming up for renewal this year, and 4 of that 14% have been done thus far, and those are the numbers we are reporting on for what has happened in those negotiations. Those tenancies specifically are not an example of what everybody else is doing in the broader portfolio. So it is difficult to reconcile because it doesn't all happen at the same time, and the experience between different tenants are different. But if a tenant has got positive trading growth, positive density, we are certainly not reducing their rental. We work out what their sustainable rental is given their turnover experience in our environments, and that's what drives our negotiations. The numbers we report on are for particular tenancies and as a subset of the overall leases in the portfolio.
I also just want to add to what Jose is saying, and that is that a few years ago we introduced the concept of a CCO ratio, which is comprehensive cost of occupation. And the reality of the times that we are operating in is that costs have escalated significantly, and a tenant can afford overall a certain amount that they can pay towards their occupancy cost. And it's for that specific reason that we moved away from just looking at rent to sales ratios, because you can easily fall into the trap of thinking that it's only the turnover that actually drive the rental, but it is that total cost. And if we look at the cost of the environment that we find ourselves in, the cost of extra diesel because we are load shedded all the time, the cost of municipal charges, it is a reality that that cost to tenants are higher than what it was, which by definition impacts your rental as a result. So it's not only trading density, it is also those other things. And it links to the question around the disputes around the Sandton City rates from Suren. We are working with the city in resolving this. We have not had the opportunity to have the Valuations Appeal Board hearing as yet. And I think we did say that together with them, we are awaiting the outcome of that appeal hearing to settle this matter. But currently, we are engaging with them and working with them on it.
Sorry, Amelia, just to maybe go back to Vincent's question, just to maybe be super clear here. So if the cost of occupancy is flat, what kind of trading density growth is sort of needed to keep your reversions flat as well? I mean, this is probably just for my own interest as well.
It's dependent on the tenant.
Yeah, exactly.
Unfortunate that we aren't giving this data on a tenant by tenant basis across the portfolio, which is where it will become clear to everybody what the connection is between it. We're reporting it at a portfolio level. So if half of the portfolio has got trading density growth of 50%, but their leases aren't up for renewal, and the other half has flat trading density growth, then your reversions are not going to be positive. It's still going to be a negotiation with the tenants that are renewing during that point in time, is the answer to that question. So I can't tell you, if the overall portfolio is going up and it's spread evenly across all of the tenancies coming up for renewal and the ones that are trading, then it'll be positive on average across the portfolio. It just so happens that most of the guys that have, in this first quarter, come up for renewal have not had the experience that the luxury, ultra luxury, and some of the other stronger categories have had over the trading period.
One should really look at turnover growth and trading density as a lead indicator of health 12, 18 months from now, because it is not possible to translate that immediately into rental. The rental experience that we're having today is as a result of what happened in 2020 and 2021. There is a lag between those two things, and as the whole environment gets better, one could start tracking it closer. But we had a huge dislocation in 2020 and 2021, and those holes in tenant cash flows haven't gone away for them. They, the fact that they have gone back to trading at trading levels where they traded before didn't mean they wiped out all their cash flow holes. So it is this thing of taking hands with our tenants, stepping forward together with them and working this out so that we all can move into a positive direction that get us into a better place than we were previously. Our reversions are not going backwards, they are getting better. And with trading densities that are getting better and performing well, it's a good lead indicator for us for 12 months from now, that this will be a much better environment than where we find ourselves in today, all else being equal. And there are so much change and uncertainty that, we can't say that will be certainly be the case, but that would be a better narrative than to think that trading density growth would have to immediately turn reversions around.
Sure, thanks.
Thank you, Amelia and Jose. The next question is from Fayaz. Is there any scenario where your major shareholder makes an offer to buy out minorities and delist?
I guess you have to ask them. Of course, we continue to engage with all our shareholders all the time as to what they want to do. And our job is to run this business and to focus on doing the best that we can for all the stakeholders of this business, shareholders, tenants, customers, and that is what we can do. We can control what we can control. We can't control what our shareholders do or don't do, and we will just continue to provide them with the best possible run business that we can do.
Okay, thank you. Just another reminder as we're drawing closer to the end, if you do have any further questions, to please send them across. Our next question is from Yesh. He says, on page 14 of the presentation, you mentioned containing costs. Please, would you walk us through how you look to do this?
Okay, so we obviously look at costs in quite a detailed fashion across the portfolio. So it's all categories of cost. Okay. There are costs that we can control, and there's costs that we can't control the rate of increase of those costs. And the uncontrollable ones are your water, electricity tariffs, and your rates. Okay. Rates, we've got full-time consultants on board that look at our portfolio whenever valuations change or the rate in the rand changes. and they look at whether the municipal laws applicable have been correctly applied. And to the extent that we feel it hasn't been correctly applied, we object, and that process follows its course. That's probably all we can do in terms of those processes. Water and electricity speaks to our ESG initiatives. We have had a huge rollout of solar in the portfolio, and we continue to do that and expand upon it going forward. It doesn't immediately translate into savings. These projects take a couple of months, a year to roll out. But the ones that we have done, we have seen the savings come through slightly better even than what we had predicted at the time of rolling out those projects. Water, if you use less, you pay less, and therefore you need to be more efficient. And we've got teams specifically looking at those efficiencies in our portfolio, whether we can have rainwater harvesting, boreholes, whatever the case may be, but overall utilizing less water from municipal supply to subvert those costs. In terms of all of the services provided to our portfolio, security, cleaning, etc., we investigate those contracts. We have procurement processes that look to achieve the best price possible, and we try to use technology as far as possible to make the service more efficient. Again, that takes some time to come into fruition. What hasn't benefited us over the last, call it 18 months, is that we have seen a decrease in those supply contracts, but have had to spend more in terms of, for example, diesel spend, more security given the socioeconomic environment that we are in. So although we are in a normalized environment spending less, this last 18 months, 2 years has just been a scenario where we've had to spend more on cleaning for COVID protocols, more on security given civil unrest, etc. And those have negated largely the contractual savings we have negotiated as those contracts come up for renewal. So we will continue to focus on costs across the portfolio at head office level as well. We've had hiring increases in the past. We are looking constantly at how we can make the teams more efficient and spend less, and continue to do so across the portfolio.
Jose, just relating to that, for those, solar initiatives that have started to bring through, some cost savings, do you have any numbers available in terms of just, I guess, the sort of proportion in terms of your overall cost base that you're seeing in terms of those savings?
Well, you can't take them all completely off the grid. Malls operate in daytime mainly, okay? And also, there's a utilization ratio. I'm not a technical expert on this, but once you get to about 30 or 35% of your normal utilization, that's probably the max you can save. Okay, beyond that, you need to store it in batteries and try and feed it back into the grid, etc. We are investigating wheeling initiatives across the portfolio. We are a large user of electricity, and that'll hopefully give some benefit. What I can say, Pranita, is all of the projects that we've approved and implemented so far have got IRRs of between 15 and 18% over 10 years. So it is quite yield accretive. It would be great if we could do more, but we are looking at alternatives to that.
Great, thank you, Jose. The next question is from Nazim. Are there opportunities to grow inorganically, portfolio or corporate?
We are in our portfolio looking at what are the opportunities that exist and how do we best use our capital for that. And as we always said, when there are an opportunity to use our balance sheet, we will do that. But as I said earlier, we are focused in this business on driving the operational turnaround, the operational delivery, turning these trading environments into rental producing entities that provide the growth that is required. And that is what our focus is on at the moment.
Great, thank you, Amelia. I think that concludes the questions that we have on the chat. If there are any last few, please do send them through. But in the interim, I'd just like to thank you both, Amelia and Jose, for shedding a lot of color on your pre-close presentation. I think we can all agree that it's been hugely helpful and insightful. And I'll maybe hand back over to you for any closing comments. But thank you again, and thank you to everyone who's joined us on the call this morning.
Thank you, Pranita. Thank you for hosting us. I hope that the information was helpful, And we have our AGM later today, as I said, and then we go into a close period. We are out in the market with our results on the 1st of August. So it's just a little over 2 months, and we will be back with our usual deep and detailed disclosure around that time, and look forward to engaging with you then.
Thanks, everyone.
Thanks so much. Take care,
Thanks, Dan.
everyone.
Bye.
Have a good day.
Bye.